Treasury bills, notes, bonds, tips, and floating rate notes are all loans to the United States government. But they do not pay you in the same way, and the word safe can hide risks that matter. In the next few minutes, we will build a clean map of the 5 marketable treasury types, how auctions work, what price and yield mean, and why selling before maturity can change the outcome. This is general finance education, not financial advice. Start with the shared structure. The Treasury sells these securities to borrow money for federal operations. They are electronic book entry instruments, not paper certificates. Marketable means they can be transferred and sold in the secondary market, unlike United States savings bonds. TreasuryDirect says the minimum purchase for a marketable treasury is $100, with additional amounts in $100 increments. Interest and principal are backed by the full faith and credit of the United States government. That promise concerns scheduled payment. It does not promise a fixed resale price before maturity. First, Treasury bills, usually called T-bills. Regular bill terms are 4, 6, 8, 13, 17, 26, or 52 weeks. Bills usually do not send a coupon payment every 6 months. Instead, most are sold below their par amount. At maturity, Treasury pays the par amount, and the difference is the interest earned. Imagine a purely hypothetical bill with a $1,000 par amount bought for $975. If held to maturity, the $25 difference would be the interest. That example is arithmetic only, not a current quote or promised return. Next are Treasury notes and Treasury bonds. Notes currently come in terms of 2, 3, 5, 7, or 10 years. Bonds come in 20 or 30-year terms. Both pay interest every 6 months, then return the par amount at maturity. The word bond is often used loosely, so check which product is actually being discussed. A Treasury bond, a savings bond, a municipal bond, and a corporate bond have different rules and risks. The fourth type is TIPS, Treasury Inflation-Protected Securities. TIPS come in 5, 10, or 30-year terms. Treasury adjusts their principal using a relevant measure of the Consumer Price Index. The semi-annual interest payment is calculated from that inflation-adjusted principal. At maturity, TreasuryDirect says you receive the inflation-adjusted principal or the original principal, whichever is greater. TIPS can still move in market price before maturity, and their tax treatment can differ from their cash flow. So inflation-protected does not mean no risk or simple in every account. The fifth type is the floating rate note, or FRN. Treasury FRNs mature in 2 years and pay interest 4 times a year. Their rate changes because it is tied to the most recent 13-week Treasury bill auction rate, plus a fixed spread set when the FRN is first auctioned. Floating does not mean the price cannot move. It means the interest rate resets by the securities rules. Now, the auction. Every marketable treasury type is sold at a public auction. Through TreasuryDirect, individuals submit non-competitive bids. You choose the amount and agree to accept the rate, yield, or discount margin determined by the auction. You do not know that return when you schedule the purchase. TreasuryDirect says non-competitive bidders receive the amount requested, subject to program limits. At the auction result, competitive bidders, generally working through banks, brokers, or dealers, specify the return they will accept. All successful bidders receive the same awarded price under the single price auction process. Price, coupon, and yield are related but not interchangeable. Par is the amount repaid at maturity. Coupon is the stated interest rate on a note or bond. Price is what the security costs now. Yield translates price, and future cash flows into a rate of return under stated assumptions. A note can have a fixed coupon, while its market yield changes every day because its resale price changes. Here is the key seesaw. The Securities and Exchange Commission explains that market interest rates and fixed-rate bond prices generally move in opposite directions. Suppose, only as a simplified example, an older note pays a 3% coupon. If newly issued, otherwise similar notes pay 4%, a buyer may demand a lower price for the older note. If new rates fall to 2%, that older 3% coupon may become more valuable, and its price may rise. The coupon did not change. The market price did. This creates interest rate risk even for Treasury securities. Government backing supports scheduled principal and interest payments. It does not guarantee the market value if you sell early. Longer maturities generally have greater sensitivity to changing rates than shorter, otherwise similar maturities. Inflation can also reduce the purchasing power of fixed payments. And if you need cash before maturity, the price available in the secondary market can be above or below what you paid. Holding to maturity changes which fluctuations matter, but it does not erase every trade-off. A holder who receives the promised cash flows may still face opportunity cost if newer securities offer higher rates. Reinvestment matters when a bill matures or a coupon arrives. Taxes matter too. Treasury interest is subject to federal income tax, while it is exempt from state and local income taxes. Individual circumstances vary, so consult official tax guidance or a qualified professional for tax questions. One more distinction: buying a Treasury security is not the same as buying a Treasury bond fund. A fund owns a changing portfolio and usually has no single maturity date at which your fund shares return a promised par amount. The SEC notes that bond funds can lose money, including funds that hold United States government bonds. Fund expenses, portfolio duration, and shareholder trading all affect the result. So use this 5-part checklist when reading about treasuries. 1. Identify the type: bill, note, bond, tips, or floating rate note. 2. Find the maturity date. 3. Separate coupon, purchase price, and yield. 4. Decide whether the claim assumes holding to maturity or selling earlier. 5. Verify the auction terms and current rates on TreasuryDirect instead of relying on a screenshot or an old headline. The map is now complete. Bills are short-term and usually earn through a discount. Notes and bonds pay semi-annual fixed interest across medium and long terms. Tips adjust principal for inflation. Floating rate notes reset their rate by a formula. Auctions establish the terms, and secondary market prices can move afterward. No example here is a recommendation, forecast, current quote, or guarantee. This video is educational only, not financial advice, and it uses original synthetic visuals with an artificial narration voice.